We are here at the FPA conference in Nashville, Tennessee, joined by Mark Prendergast. He is with Inspired Financial out of Huntington Beach in Orange County, California. Thanks for joining us.
Thank you very much.
We're going to talk tax strategies here and tax planning in uncertain times, politically, for sure. You're getting a lot of questions from your clients about what should I do, what's going to happen. Tell me what they're asking you.
They are asking what we should do, but our basic premise is that we use existing laws and we try not to speculate what the changes will be, because those speculations come out and they just continue to change, and we don't like to make a move based on speculation. So we use current law, but we build flexibility into that, and we try to use evergreen type strategies, things that we're fairly certain are not going to change, such as taking IRA distributions or making charitable contributions from IRA distributions, donating appreciated stock. And one of my favorite ones, I think, is for clients that are taking distributions from their required minimum distributions from their IRAs, that we have them avoid making estimated tax payments because they don't like writing that check quarterly. And so we'll just do that as a one-time withhold out of the IRA in November or December. Their money works for them longer, and they don't have that pain point of writing the check. The financial pain is there, but they just don't feel it.
In terms of tax strategies that most folks aren't aware of that are underutilized, that you help guide them towards, what are things that people just overlook or just aren't aware of that could really help them out?
One is you have to be 70 and a half or older, taking of the age to take required minimum distributions from your IRAs. And when you're of that age, you can donate directly out of your IRA, and that keeps your adjusted gross income lower. And there's so many different factors that spin off of adjusted gross income: the taxability of your Social Security, your deductibility of itemized deductions, like investment advisory fees, tax prep fees, medical deductions. So the more you can keep adjusted gross income down, the better.
Let's talk about some of the biggest mistakes folks make in tax planning. We all make them. We all probably don't take advantage of some of the strategies that you just mentioned. But just general mistakes that folks make. What are some of the things you see and try to guide clients towards?
I think one of it is the alternative minimum tax, AMT. That traps a lot of people, and so they take actions that actually become counterproductive. They may be prepaying their state income taxes in December rather than waiting till their April liability, trying to forward that deduction. Well, state income taxes for AMT is non-deductible, so they're doing something that trying to get a deduction, getting no value for it, and they might get it the next year, so it's better to wait and pay the next year. Same thing for property taxes on their houses. Sometimes California we pay in April and December, and in December they may be trying to pay the next April. It becomes counterproductive when you're in AMT. And another one that particularly bothers me is a lot of financial planners and tax advisors say that you should pay your investment advisory fees on your IRAs rather than having it deducted from your IRA. They say, oh, you should write a check and pay with it from non-qualified funds, from your regular checking account or savings account. And that's just grossly tax inefficient, because your IRA already is pre-tax dollars, and the goal is to pay normal expenses with pre-tax dollars. And now they're trying to say, well, I want a deduction for it so I can keep my IRA growing, and that's a good thing, but they aren't getting benefit for that deduction. It goes in miscellaneous itemized deductions. Number one, it's subject to 2% of your adjusted gross income, so you're losing that part as a deduction. And then on top of that, it's subject to AMT. If they're an AMT, they're throwing the deduction away, and so they're dissipating their non-qualified assets. And when a person gets into retirement phase and they want those non-qualified assets because the taxes are cheaper on it, as opposed to you pull $100 out of your IRA and you're going to be paying $25 to $35 in taxes on every time you pull, and that's just inefficient.
Right. Folks, if you ever doubted whether you needed a CFP, especially as you get into these complicated tax issues, here's a good reason why you need one right here. Mark Prendergast, we appreciate the time and thank you. Enjoy the rest of the conference.
Sure thing.